Verizon has just released their earnings, and year to date they are down 15.24%. And if we look at the last 5 days, they have both dropped significantly when AT&T released their earnings and also when they released their own earnings. So they have dropped from 49.41 around 11% down just over the last 2 days. And as the news says, Verizon Communications on Friday reported June quarter adjusted earnings that missed estimates as it added fewer postpaid wireless phone subscribers than expected. VZ stock also tumbled as the telecom lowered their 2022 earnings per share guidance. As we can see, Verizon Communications hits a new one-year low on a very disappointing earnings sheet released, and that the market did not like. Also, things haven't been going their way. If we look at Warren Buffett and Berkshire Hathaway in fourth quarter of 2020, they posted a new holding of 147 million shares of Verizon, and they increased that holding just this quarter after in 21 first quarter. But 1 year later, in the first quarter of 22, we see that they have sold 99.1% of their shares, and they even took a bit of a loss on that one. But let's take a closer look at Verizon Communications fundamentals, and as we can see here, they are trading at a PE ratio of 8.91 compared to their 5-year average PE ratio of 11.47, which is around 22% below, so that is looking quite okay. And they are also trading with a book value way below their 5-year average at around 41% below. And as we can see here, they have a very good dividend. They have a yield of 5.37, a payout ratio just below 47, which is quite okay, but a very lackluster 5-year growth rate of only around 2%. But they have been growing their dividend for 18 consecutive years, so that is at least something. Let's take a closer look at the financials, where there are definitely some good things, but also some bad things. For example, the revenue is growing year over year, which is very nice to see. And also, if we come down here to the net income, in 2017, there was a really good year. Then it dropped down a bit. I think there was a spin-off or something, but ever since then, they have started to grow again. So that is very nice to see as well. If we look at the cash flow, that is also growing. As you can see here, their cash from operation minus the capital expenditures is definitely growing, where we have around 7 billion here and around 19 billion here in 21. If we jump into the balance sheet, things are looking a bit more dim. As you can see here with cash and cash equivalents, they are not having a lot of cash on hand. And if we scroll down here, then it starts to get even more bleak, because as you can see, their long-term debt is extremely high, with $143 billion just in debt for 21. And as we scroll even further down, total common shares outstanding is not decreasing at all, which is not good to see. But again, they are trying to get a lot of capital in, so they are issuing more shares. But telecommunications is a very capital heavy industry, so maybe it can be a good idea for them to take on the debt to further grow their business. That was how some of the numbers behind look, but let's take a closer look at the intrinsic value to get an idea whether or not the stock is over or undervalued. And to do that, we have 4 different valuation models that will help us guide us in the right direction. And the first one is Graham's revised valuation model, where we have all these inputs, with the Y being the current yield of the AAA corporate bonds at 3.75 right now, and that gives us an intrinsic value of $51.26, and the current price of Verizon is 44.45. Next up, we do have the discounted cash flow analyst model, where we put in the free cash flow produced over the years and apply a growth rate, and in the end it will give us a future free cash flow, and then we can discount that back to a fair value today. And if I do this and apply a growth rate of 5%, which is kind of conservative, but I like to be conservative, and I have a discount rate of 8.5, I get a fair value of 45.97. If we use the next model, which is a dividend discount model, where we put in the dividend stats and apply industry average weighted average cost of capital with the growth rate, we get an intrinsic value of 56.48, way above those 2 other valuation models we've used so far. And in the last one, I don't really like to use it because it's a multiples valuation and there isn't that many competitors for Verizon, but I had put in AT&T and Deutsche Telekom, and it gives a stock price of 49.37, so maybe it's okay. If we sum all these up and apply a margin of safety of 10%, it gives us an acceptable price of 45.69, and if you prefer not to use a margin of safety at all, it's around 50. So right now it should probably trade around a fair value according to my model and my margin of safety. Let me know down in the comments if this is a company you are interested in, or if you're maybe already holding it. And thank you so much guys for watching this video, and please don't forget to like and subscribe to the channel.